What's up, everybody? It's Bill, and today we're diving deep into the world of investing. Whether you're just starting out or you've been in the game for a while, understanding the different ways you can grow your money is absolutely crucial. There are tons of options out there, each with its own quirks, benefits, and risks. That's why in this video we're breaking down 10 key investment vehicles you absolutely need to know. We'll explore what they are, how they work, and the potential rewards and risks they offer. We'll cover everything from the stock market to real estate, from bonds to crypto, and even those good old-fashioned savings accounts. By the end of this video, you'll have a solid foundation to start making informed decisions about where to put your hard-earned money to work. So buckle up, grab a notebook, and let's get started on the road to financial freedom.
First up, let's talk about stocks. In simple terms, when you buy a stock, you're buying a small piece of ownership in a publicly traded company. That's right, you become a shareholder, and as the company grows and becomes more profitable, the value of your shares can increase, potentially making you some serious cash. But that's not all. Some companies also pay out dividends to their shareholders, which are basically a share of the company's profits distributed to investors. It's like getting paid just for holding onto a piece of the company. Now, who wouldn't want that? However, remember that the stock market can be volatile. Prices can go up and down, and there's always the risk of losing money. That's why it's crucial to do your research, invest in companies you believe in, and diversify your portfolio to spread the risk. Don't put all your eggs in one basket, or as I like to say, don't put all your avocado toast money into one single stock. Spread it out, be smart, and remember, long-term growth is the name of the game.
Now let's move on to bonds, which are a completely different ballgame compared to stocks. Think of bonds as a loan you're giving to a company or government. When you buy a bond, you're essentially lending them money for a fixed period, and in return, they agree to pay you back the principal amount plus interest. Bonds are often considered less risky than stocks, especially government bonds, because they offer a fixed income stream. You know exactly how much interest you'll earn and when you'll get your principal back. This makes them a popular choice for investors looking for a more stable and predictable return. However, bonds aren't entirely risk-free. One of the main risks is interest rate risk. When interest rates rise, the value of existing bonds generally falls. This is because investors can buy newer bonds with higher interest rates, making the older, lower-yielding bonds less attractive. Another risk to consider is credit risk, which is the risk that the issuer of the bond, whether it's a company or government, may default on their debt and fail to make interest payments or repay the principal.
Alright, let's dive into mutual funds. Imagine you're pooling your money with a bunch of other investors to buy a massive basket of stocks, bonds, or other assets. That's essentially what a mutual fund is. You're not buying individual stocks, you're buying a piece of the whole pie. The beauty of mutual funds is diversification. They spread your money across a variety of investments, which can help reduce your overall risk. Think of it like this. If one stock in the fund tanks, it won't necessarily sink your entire investment. Another perk? Professional management. You're not picking stocks yourself. A fund manager does the heavy lifting for you. They research, analyze, and make investment decisions based on the fund's objectives. It's like having a personal financial advisor, but on a larger scale. Now keep in mind that mutual funds come with fees and expenses. You're paying for that professional management and diversification. So factor those costs into your overall investment strategy. But hey, if you're looking for a hands-off approach to investing with built-in diversification, mutual funds could be a solid option. Now let's talk about ETFs, or exchange-traded funds. Think of them as the cool cousins of mutual funds. They offer similar diversification benefits but with a twist. ETFs trade on stock exchanges just like individual stocks. This means you can buy and sell ETFs throughout the trading day, just like you would with Apple or Tesla stock. This gives you more flexibility and control compared to mutual funds, which are typically priced only once a day. Another advantage of ETFs is their typically lower fees compared to mutual funds. Remember those expense ratios we talked about? ETFs tend to have lower expense ratios because they often track a specific index, requiring less active management. Plus, ETFs can be more tax efficient than mutual funds. They tend to generate fewer taxable dividends, which can save you money come tax season. It's always nice to keep more of your hard-earned cash, right?
Let's talk about real estate, one of the oldest and most tangible investments out there. You're not buying a piece of a company, you're buying a physical asset, a house, an apartment building, or even a piece of land. Investing in real estate can provide you with two main avenues for potential profit: rental income and property appreciation. Rental income is pretty straightforward. You collect rent from tenants, which can create a steady stream of passive income. Appreciation, on the other hand, occurs when the value of your property increases over time. This can happen due to factors like inflation, a growing local economy, or improvements you make to the property. Real estate investment trusts, or REITs, offer another way to invest in real estate without actually owning physical property. REITs are companies that own, operate, or finance income-generating real estate. Think of them like mutual funds for real estate. Now, while real estate can be a lucrative investment, it's not without its risks. Property values can fluctuate, just like any other market. Remember the 2008 housing crisis? Yeah, that was rough. Another factor to consider is liquidity. Real estate isn't as liquid as stocks or bonds. Selling a property takes time and effort. You can't just click a button and cash out instantly. Managing rental properties can also be a hassle. Dealing with tenants, repairs, and vacancies can be time-consuming and stressful. If you're not cut out for the landlord life, it might not be the best investment for you. However, despite the risks, real estate can be a powerful tool for building long-term wealth. It can provide passive income, hedge against inflation, and offer potential tax advantages. Just remember to do your due diligence, research the market, and be prepared for the responsibilities that come with being a property owner.
Commodities. These are the raw materials of the global economy, the things that people use every single day. We're talking about everything from gold and silver to oil, wheat, and coffee. These are the building blocks of the products we rely on, and their prices can fluctuate wildly based on supply and demand. Now you might be thinking, Graham, I'm not trying to buy a barrel of oil. Where would I even put it? And you'd be right. Most people invest in commodities through futures contracts, which are agreements to buy or sell a specific amount of a commodity at a predetermined price and date in the future. It's a bit complex, but essentially, you're betting on the future price movements of these raw materials. Investing in commodities can be a way to diversify your portfolio and potentially hedge against inflation. When the cost of goods and services rises, commodity prices tend to increase as well. So, by holding some commodities, you might be able to offset some of the negative effects of inflation on your overall portfolio. However, remember that commodity prices can be incredibly volatile. They're influenced by a wide range of factors, including global politics, weather patterns, and economic conditions. Before diving into commodities, it's crucial to do your research, understand the risks involved, and consider whether this type of investment aligns with your overall financial goals and risk tolerance.
Cryptocurrencies. They're digital or virtual currencies that use cryptography for security. Now, cryptography might sound complicated, but just think of it as a way to secure transactions and control the creation of new units of the cryptocurrency. Bitcoin, Ethereum, Dogecoin. These are just a few examples of the thousands of cryptocurrencies that exist. One of the key features of cryptocurrencies is their decentralized nature. Unlike traditional currencies issued by governments, cryptocurrencies operate on a decentralized network, typically a blockchain. This means that no single entity, like a central bank, controls the cryptocurrency, making it potentially more resistant to censorship and manipulation. Now, I know what you're thinking. Cryptocurrencies have been making headlines for their potential for high returns. And it's true, some people have made significant profits from investing in cryptocurrencies. However, and this is a big however, cryptocurrencies are also incredibly volatile. Their prices can swing wildly in short periods, making them a high-risk investment. Before you jump headfirst into the world of crypto, it's crucial to understand the risks involved. The cryptocurrency market is still relatively new and unregulated, making it susceptible to scams and market manipulation. Additionally, the technology behind cryptocurrencies can be complex, and it's essential to do your research and understand how it works before investing your hard-earned money.
Let's talk about certificates of deposit, or CDs for short. These are a type of savings account offered by banks and credit unions that offer a fixed interest rate for a specific period, known as the term. Think of it like this: you're loaning the bank your money for a set amount of time, and in return, they pay you interest. Now, the great thing about CDs is that they generally offer higher interest rates compared to traditional savings accounts. Why? Because you're committing your money for a fixed period, giving the bank more flexibility to lend it out and earn a return. The longer the term of the CD, the higher the interest rate you can typically earn. But there's a catch, and you knew there had to be one, right? With CDs, your money is locked in for the duration of the term. If you need to withdraw your funds before the maturity date, you'll likely be hit with an early withdrawal penalty, which can eat into your interest earnings. So, when are CDs a good investment? They're a solid option if you have a chunk of money that you don't need to access for a specific period, and you're looking for a predictable return. They're also a relatively low-risk investment, especially if you choose a CD from an FDIC-insured bank, which means your deposits are insured up to $250,000 per depositor, per insured bank. Alright, so you want a completely safe place to stash your cash, right? Somewhere you know it's going to be there when you need it? That's where savings accounts come in. These are about as basic as it gets in the financial world, offered by almost every bank or credit union out there. You deposit your money, they hold on to it, and in return, they give you a little something called interest. Think of it like a small thank you for letting them borrow your money, which they then use to give out loans and do other banky things. Now, the interest rates on savings accounts aren't going to make you rich anytime soon. In fact, they're often barely above zero, especially compared to the potential returns you could get from things like stocks or real estate. But, and this is a big but, savings accounts offer something those other investments don't: absolute safety and liquidity. Your money is federally insured, meaning even if the bank goes belly up, you're still guaranteed to get your deposits back, up to a certain limit, of course.
All right, let's talk about the future, specifically your retirement. You might be thinking, retirement? I just started investing. And that's great. The earlier you start thinking about retirement, the better off you'll be. Trust me, time flies by faster than you think. Retirement accounts are specifically designed to help you save for those golden years. We're talking about accounts like 401(k)s, and IRAs. These accounts come with some serious tax advantages that can supercharge your savings over the long haul. Now, there are different types of retirement accounts, each with its own set of rules and contribution limits. For example, with a traditional 401(k), you contribute pre-tax dollars, meaning you lower your taxable income today. The money then grows tax-deferred, and you only pay taxes when you withdraw it in retirement. IRAs, or individual retirement accounts, are another great option. These offer similar tax advantages to 401(k)s, but give you more flexibility in terms of investment choices.
So there you have it. We've covered the top 10 investment vehicles, from the stock market to real estate, from crypto to good old-fashioned savings accounts. Each one has its own pros and cons, and the best choice for you depends on your individual financial goals, risk tolerance, and time horizon. Remember, investing is a marathon, not a sprint. It's about making smart, informed decisions that will help you build wealth and achieve your financial dreams over the long term. Don't get caught up in the hype or try to time the market. Instead, focus on creating a diversified portfolio that aligns with your risk profile and stick to your investment strategy. Most importantly, do your own research. Don't just take my word for it. Educate yourself about the different investment options available, understand the risks involved, and make informed decisions that are right for you. There are tons of resources available online and in libraries. You can also consult with a financial advisor if you need personalized guidance. Thanks for watching, and don't forget to like, comment, and subscribe for more videos on personal finance, investing, and building wealth.